Good morning and welcome to Origin Investments, special session on the banking crisis and the reverberations across real estate potentially that I'm going to be covering. My name is David Scherer. I'm co-CEO, co-founder of Origin Investments. I'm thrilled this morning to have Sheila Bair, someone that I really looked up to and followed in the great financial crisis as sort of a pillar of leadership and stability in a really uncertain time. And it's incredible how these standard deviation events seem to happen more than every 100 years or 50 years these days. So I'm going to circle back and give her a full introduction that she deserves in a moment, and also introduce Marc Turner in a moment. So with that, let's start. We have a lot to cover, and we want to cover live questions. Our agenda this morning, we're going to start with myself interviewing Ms. Bair. Then we're going to open up to live questions from the audience that I'll curate and ask. Please ask as many as you can. Use the Q&A feature. Do not use the chat. It just helps me organize. Once we're done with that live Q&A, I'll be covering the impact that I believe will happen on multifamily real estate. Of course, that's all we do at Origin, so we're not going to cover other real estate asset classes. Then my colleague and longtime, and I will introduce him now, Marc Turner. He's been with us 8 years, over 30 years experience in asset management, investment management, and really does an amazing job with our portfolio. He wrote an article on our risk management relative to this crisis, and he'll give an update this morning. And then we'll handle more Q&A, just Marc and I. Sheila's off to something else at that point. So with that, I'm going to jump into introducing Sheila. So Sheila has had a distinguished career in government, academia, and finance. She's widely respected for her expertise in financial regulation, consumer protection, student debt, and cryptocurrency oversight. That's very relevant. Ms. Bair was chair of the FDIC, as I mentioned, from 2006 to 2011. She steered the agency through the GFC and worked to bolster public confidence in the nation's banking system. And those of us that were professionals during that period remember that was extraordinary work that she did. During her tenure, she received numerous awards, including the JFK's Libraries Profile and Courage Award. Ms. Bair remains active in public policy as a senior fellow for financial stability, senior advisor and chair emerita of the Systemic Risk Council. She's also a frequent contributor to major business networks. And Sheila, I understand you've written some children's books as well. Is that right?
Yeah, I have. Yes. Thanks for mentioning them. Yes. My current passion.
Of course. So we're going to jump right into some, and a lot of these questions were also derived from questions that were emailed in. But I'm going to jump right in, Sheila. And
sure.
My first question, and we were talking about this a little bit prior to the webinar. You know, we've seen the run on banks, 2 bank failures. One bank has been sold over the weekend, Credit Suisse and UBS. UBS essentially bought Credit Suisse. How did all this happen? You know, how did we get here?
Yeah, it's a good question. It's pretty surprising the way the regulatory community seems to be playing catch up in all this. I mean, look, when interest rates go up, financial asset values go down. And so banks own a lot of financial assets. So it shouldn't be a surprise that there would be some banks, that have not managed their interest rate risk as well as they should have. So I hope going forward, this has certainly been a wake-up call. I hope it's not too late to play catch up. The private analysts are they're going through, picking through all the available public data on the mid-sized banks now to see who's got a lot of unmarked securities and heavy reliance on uninsured deposits. Those are really the big risk factors with Silicon Valley Bank that led to its demise. I don't think that's a huge group, and certainly they're better aware now of that risk and the need to manage that risk. The Fed has also opened up a liquidity facility so that they can, unmarked securities, they can pledge at par and borrow 100% at par value against them. So that's helping with liquidity. But I think it's going to get worse before it gets better. Fear is setting in now, and we can talk about the systemic risk determinations that were made, which I was critical of. I think that made things worse, not better. But these banks, it's a classic Jimmy Stewart problem. If you go in, all the depositors go in and decide to take their money out at the same time, you'll force an otherwise healthy bank to sell, because if they have to, they just can't raise cash enough. And that's how you define failure. If a bank becomes insolvent or a bank becomes illiquid, it can't raise the cash to meet its deposit request. And of course, those two are relate to each other, because if a bank has to start selling at fire sale prices and realizing unmarked market losses to meet redemption requests, then they have a solvency problem because they don't have the capital to absorb the loss. So we're not out of the woods. I think everybody needs to be vigilant. There's lack of clarity about which banks have uninsured coverage and which banks do not. And so people should take steps to protect themselves. But I would say, I think the vast majority of banks are including regional banks, are quite healthy. If you're uninsured, know your bank. You can download the call data. If they're publicly traded, you can look at their public financial statements and get key data about their mix of insured and uninsured deposits, how much in their securities have not been marked to market. That is pretty readily available. And if you're seeing things you don't like, assess, your uninsured deposits, or at least have a conversation with the bank management about how they're handling this risk. And until the government does something more definitive about uninsured, I think that's what everybody should be doing.
You look at SVB. Let's focus on them.
Right.
Where do you place most of the blame, or is it the bank executives?
Yeah.
Is it the Federal Reserve? Is it Congress? Is it legislation? Like, where does this blame fall?
Yeah, it's a good question. I think the accountability first and foremost rests with bank management. It was their job to manage risk. Managing your interest rate risk is kind of banking 101. It's like you load up, which is what they did. They loaded up on about $80 billion of long-term government-backed debt, which from a credit risk perspective was safe, right before the Fed started raising interest rates. And it wasn't exactly a secret the Fed was going to be raising interest rates, and then didn't effectively manage that interest rate risk. At the same time, they were over 90% reliant on uninsured deposits. This was hot money. These were institutions. They had a relationship with these venture capitalists and their portfolio companies that the venture capitalists had invested in. But it was still, they weren't sticky. They were paying high rates on those deposits. It was a non-diversified group. So it was a kind of this little cliquish group of venture capitalists and portfolio companies. And when they all decided to run, they all decided to run. So there were some just basic fundamental mistakes in management that never should have happened. But as basic as those were, and as transparent as those were, the examiners should have caught it. They absolutely should have caught it and intervened much earlier than what we saw, this sudden collapse. They had $40 billion of deposits go in one day. I've never seen that. We never, even with accelerated deposit withdrawals, during the great financial crisis, 40 billion in one day is an amazing amount. And certainly for a $200 billion bank, it was an amazing amount. So that was, I think, one thing. Another thing, regulators have a tendency to fight the last war. And so I do think the regulators have still been too focused on credit risk, which was the issue during the great financial crisis, capital, less on interest rate risk and liquidity risk, which is really the issue now. And I think also they're learning quickly that with social media, though I think actually the Silicon Valley Bank, they would have withdrawn quickly just because it was such a close-knit group of people that communicated with each other. But clearly social media helped spread the word and stoke the fire of uninsured deposit withdrawals. So that's a lesson learned for the regulators as well. But frankly, the accountants, the auditors need to step up here too. There's, banks of all sizes do not have to mark securities that they put in something called a hold to maturity, HTM portfolio. And they are required, however, to not only have the intention to hold those securities to maturity, but have the capability to do so. And clearly a bank with this kind of volatile, deposit base was not, the auditors should have looked at too and challenged it, as should the board, and they didn't. So I would say there is a lot that could have been done better here. It is troubling. We've had this long extended benign period of in banking and low volatility facilitated by, highly accommodative monetary policy. And once that reverses, you're going to see things like this happening, and regulators need to get ahead of it. But so that, yes, they could have done things better, but I first and foremost, management is accountable. there's also been a lot of chatter about this 2018 law that created a more streamlined, shall we say, supervisory and regulatory regime for the mid-tier banks, kind of separated them from the much larger institutions. And I think some of that law and the Fed's implementation of that law could have done better. But I don't think that law was a key driver of the failure of SVB. That was just basic fundamental mismanagement and examiner oversight. And I do think that's an important point to make, because I don't want people to get this idea that regional banks are somehow had this massive deregulation in 2018 and they're all shaky. That's just not true. You know, regional community banks were the heroes during the great financial crisis. They were the vast majority, were highly stable. Their share prices held up. They kept lending when the big banks were retrenching because of all the credit losses they were experiencing on their mortgage-backed derivatives and structured products. So it's been a traditionally stable sector. I think it still is. It's a really important part of the economy, which is why I would say if you're uninsured at a regional bank, you know, take a look first. Their financials are probably just fine, and talk to your bank if you have any concerns.
Yeah, I'm going to answer my own question a little bit, because I do agree with you, Sheila. Like, I think the onus here is on the management at SVB.
Right.
You know, everyone knew the Fed was going to raise interest rates. They had stretched, and people don't realize, but you know, public companies, they need to beat earnings or meet earnings every quarter, or the market punishes.
Right.
And it sort of incents management to seek more and more yield.
Yeah,
And
it
how do you
does.
get more yield? You go a little bit further out on duration. You don't buy a
Right.
T-bill, you buy a 1 year, you buy a 2 year, you buy a 5 year.
Right.
And they really expose themselves to an risk chasing earnings.
Yeah.
Here's
No,
my
that's right.
point. And this is a big difference between public and private companies. And I'll form it in a question, but
Sure.
as a manager, we're a real estate private equity manager. If I take incentive pay, that's the analogous of stock options for a public company, right? We call it promote.
Right.
If
Right.
me and our team earn incentive pay and later investors lose capital, right?
Mhm.
There's called a clawback. I have to give that money back.
Mhm.
That's in
Mhm.
every operating agreement, every fund we have, you know, and then there's a high water mark, and there's all sorts of rights afforded to our partners. Why is it that SVB executives don't have to give back their stock compensation for the
Right.
last 3 years? I mean, they
Right.
ran up risk, they destroyed value. Why do they get to keep that money?
Well, they may. I mean, there is the FDIC. It has to sue to claw back, so it has to go through litigation to do that. There's no automatic clawback when the bank fails, which actually for the systemic institutions in Dodd-Frank, we created a special procedure for systemic institutions, and there is automatic clawback and firing of the board and the top management. But for these smaller institutions that are resolved more with the FDIC's more standard toolkit, the FDIC has to sue them. Now we have, and I'm sure they will, they will sue here too. And you can fire them. You can fire them immediately. And when a bank goes into resolution, we always fire the management. It was just, you know, as a matter of course. So there is some authority to do that, but it could be cleaner. I believe the administration is going to be proposing legislation to give the FDIC more, you know, automatic powers to claw back pay when you have a failure like this. But yeah, I said personal accountability does matter a lot. And so I think that's an important piece of longer term reforms we may want to look at. It's not going to really help with the immediate problem of potential bank runs, but certainly it's a longer term solution. You know, another issue we ran into when I was the chair of the FDIC, when we were implementing what's called orderly liquidation authority for the biggest banks, was whether so some of the banks were then getting D&O insurance to cover clawbacks, which I think needs to make sure you don't allow banks to do that, because that pretty much, it needs to come out of their own pocket to have the impact on incentives that we want. It needs to come out of their own pocket, not their insurance company's pockets. That's another wrinkle on this. I think, yeah, potential loophole that they need to close.
That's a good point, because you have to keep going into the weeds further and further.
Yeah, no, that's
So
true.
one of the things that we were talking about this morning, Marc and I and the Origin team, we had to do an awful lot of research on risk management that we weren't normally doing in the last couple of weeks. So for example, not only were you looking at our own deposits, but also the deposits of our fund administrators, because the capital as it comes into Origin, we don't touch, it goes to the fund administrator. So what are they doing? Because the money's actually sitting there,
Right.
and you're in the weeds, right?
Right.
So
Right. Yeah.
we've learned a lot, but we had a wonderful conversation, Sheila, about things that investors of Origin, people who either own businesses or have deposits at banks, should be thinking about and could potentially do to protect their deposits.
Right.
Could you share a little bit of that?
Sure. So there are a lot of ways. The headline number is 250,000. That's a general rule per account per bank. But depending on how you structure your account as a household, you can get a lot more than that. A joint account, you can get 500,000. You set up a trust account for your kids, you can get 250,000 each, up to 5 people, I think. So just through account structuring, you can get a lot more than 250,000 in an individual bank. And there's a tool that we actually launched during the great financial crisis during my tenure. It's called ED. And you can input the information and it will tell you, depending on how your account is structured, how much insurance you have and whether you're covered. You should also talk to your bank. Many banks partner with these deposit networks, I guess you'd call them. There's basically switches. So if they have a depositor coming in with a large deposit, these services will break the deposits into $250,000 increments and then ship them out to other banks, and they'll do the same for other banks. It's a switch, and that's been successful. A lot of businesses I know use that and have used that successfully. I think it's a little clunky if you're talking about a transaction account where there's a lot of money going in and out constantly, and that's a unique problem. These transaction accounts that are used by businesses and other organizations for payroll, operational expenses, typically the amount is going to be, it needs to be in one bank. It's not well adapted to these deposit swapping programs. And so we saw this during the great financial crisis. It was a real problem. And the smaller banks in particular were losing these uninsured accounts to the too big to fail banks. So we implemented something called the Transaction Account Guarantee Program, which basically provided unlimited coverage for these business accounts, organizational accounts. And so there is authority for the FDIC to reinstate that program, though it now requires an act of Congress, but there's a fast track procedure that could provide it, but the president needs to request it. So I have been urging the administration to go ahead and request that authority and give the FDIC the power to institute this program, because we are seeing, I fear, an acceleration of uninsured deposit runs. And again, this is just, if you don't stabilize the system, you're just going to make the big banks even bigger, because that's where the money goes. JP Morgan Chase is probably, I know they're bringing in a lot of deposits right now because they're viewed as the safest of the systemic institutions, and one that the regulators would never let fail. So I'm hoping that occurs. But pending that, you need to look at these account restructurings. Others use sweeps into money market accounts. So, you're again, talk with your bank to see if they offer that kind of service. I know actually at Silicon Valley, a lot of the money was swept into money market accounts. I would caution make sure the sweep is into a government money fund that invests in T-bills or very short-term treasuries, because some of these money market funds are not stable either, as we've seen. They've had to be bailed out a couple of times. So make sure if you're using a sweep in a money market fund that it's a government short-term money fund. But those are the tools that are available. And again, a lot of information at the FDIC's website and by talking to your bank.
Sheila, the biggest question that I have, so I'm guessing a lot of our clients have too, are banks FDIC guaranteed to an unlimited amount like SVB was, or Signature was, or is this unfolding and later we're going to find out that you thought you were, but you're not? It's very vague, isn't it? Like what?
It is. Yeah, no, it's not. It's not. The systemic risk determination is first of all, I don't think those institutions were systemic, and I think saying they were was dissettling to the market, because it created all this massive uncertainty and said, well, is all who else? What are the rules now? We thought it was 250,000. What are the rules now? And The legal authority, if you want to use a systemic risk determination to protect uninsured deposits, and clearly the government is trying to create that expectation, but they don't have the legal authority to do that absent of, one by one systemic risk determination. That's why they need to go to Congress for this authority to provide a broad-based guarantee. And I said, I was on Fox last week, and I said, it kind of reminds me of Bear Stearns when, Bear Stearns was bailed out very early on. And it created an expectation that these other securities firms that were highly exposed to mortgage-backed securities and derivatives were going to get bailed out. And I know that's why Lehman Brothers didn't really take much, they could have sold themselves. They would have been a steep discount, but they didn't do it. They were waiting for their bailout. And then when they started to fail, the government looked at it and said, well, we don't have legal authority to bail them out. So creating this expectation without the legal authority to back it up is very dangerous. And so I would say, I don't, I'm staying below I do anyway, but I think until they actually do something approved by Congress that provides a system-wide protection, I don't think you can be sure at all. And I think that's very unfortunate, which is again why you're seeing so much money going into the too big to fail institutions right now.
Yeah, I completely agree with you. This is a time for risk management. Sounds like
Yes,
you're doing it for yourself. It is.
Yes.
There's tremendous uncertainty, and there's a precedent too that the government did both things in the financial crisis, and it could happen
That's right.
again.
That's right.
And it's
That's exactly
probably
right.
because they actually don't have the authority to keep doing it and doing it.
Yeah,
So,
that's right.
I think we're agreeing to urge the listeners to take the steps to ensure that your accounts are insured.
Yes.
And that doesn't mean leaving a regional bank. It just means
No.
making sure, and there's lots of ways to do it
Right.
as well. So let's shift a little bit to what this means for the economy. I'm going to cover a little bit of that as it relates to real estate later, but I'd love to hear your take on what's going to happen to, well, let's start with the Federal Reserve, but you can't really talk about the Federal Reserve and their tightening or quantitative tightening or interest rate increases without also talking about what's going to happen to the M2 and M3 money supply as banks
Right.
start to fixate on their own balance sheets.
Right. Well, look, I think they need to hit pause. I wrote a piece last December. Money supply has shrunk considerably. Interest rates have risen. Their primary tool is raising the target Fed funds rate, which has gone up by over 6,000%. They started at about 0.08%. It's now a little north of around 4.5, I guess. We'll see what they do at the next FOMC meeting. But they've gone, look, I'm an inflation hawk. In 2010, I said, they needed to start normalizing rates. Paul Volcker, who is someone I worked well with and admired and respected tremendously, he hated inflation targeting. He's got a great book called Keeping at It that breaks it down because, keeping monetary policy accommodative just in some, really unproven desire that somehow a little inflation is going to help the economy just creates a lot of system instability. So they didn't. They kept it going for about 14 years. Ironically enough, in 2010, before I left the FDIC, I convened for banks the conference on interest rate risk management because I thought the Fed was going to go ahead and raise rates, and they didn't. So it was a mistake. In retrospect, we knew they kept it too low, too long. It's created a lot of buildup of, the financial assets were booming during the accommodative period, and now that process is reversing itself. I still think this can be managed. There's risks that can be managed, but bank managers and examiners need to be vigilant about the impact of this and to make sure that banks have stable deposit franchises that will not run on them, forcing them to sell unmarked securities at significant loss. But I do think they should hit pause, not just for the banking system, but for the real economy. There's only so much that the real economy can absorb. And they've really been targeted on the labor market. And it seems like they do want to engineer at least a mild recession. I mean, there's, their own projections, they're looking at a couple million of jobs lost. And that concerns me as the way to tame inflation. You look at this group would probably be sensitive to that more than anything. You've got, real wages have been falling. So they have, right? They may still be above the inflation target, the 2% inflation target, but they're way below what real inflation is. So I can't say, and Lil Breener had a great speech on this. Labor wages have not been driving an inflationary spiral. There are other factors. Housing is one. Housing has been supply constrained. Unfortunately, we need more multifamily. It's been supply constrained since the great financial crisis, and pouring $2.5 trillion of MBS purchases in that market, taking mortgage rates deeply negative, had the predictable effect of turbocharging demand. Home prices go into single family homes, but we saw a similar dynamic with rental prices too. You just turbocharge. There were, like, I think, back-to-back over 20% increases in housing in 2020 and 2021. It slowed down in 2022, but it's still running about 8%. It's a huge component of the inflation indices. So if they need to, I think they should just hit pause and assess. That doesn't mean they can't keep tightening later, but as this group I'm sure knows, there's a lag between when housing starts to slow down and when that starts being reflected, in the metrics that we all look at. So they should assess and see, let the housing data flow through to the inflation indicators and see what the numbers look like. And then they'll have more information. But I do think tolerating a little inflation longer is better than sending this country into another deep financial crisis. So forget the soft landing. I mean, the worst recessions we've ever had have not been because of slowdowns in the real economy. They have been caused by massive contractions of credit because of financial crisis. And the Fed needs to avoid that risk at all costs. So I'm thinking and hoping they will hit pause, they will assess. And again, they can continue tightening later on, but for now, they just need to slow down and let everybody, fully understand and manage the risks that have been created by these massive interest rate increases.
I think we're going to shift. Whenever I hear you talk, I want to answer, but they're here to hear you. So I'm going to shift to live Q&A.
Okay,
so we have
great.
quite a few that come in, and the questions
right.
have come in. So I'm going to move to, if you include your name, I'll include your first name. So this is a good question that I was going to answer later, but you can answer it as well. This is from Edson. He's talking about multifamily financing. That's what we really do here. We own, operate, develop, and lend multifamily across the country. So his question is, regarding financing multifamily, do you think the current market conditions will have a negative impact for getting new sources of debt?
Yeah. Well, it may well. I mean, I think I was a big supporter. I used to be the chair of the Fannie Mae board, and I thought we should be able to do more in multifamily. I know there are private interests that provide that financing too, and they don't like the GSEs in bold. But given the need we have for affordable housing, that would be one lever to increase the caps that the GSEs could do on multifamily to provide that as an additional source. I think I also, you tell me, but based on my readings and research, another big impediment or cost driver are, restrictive zoning, permitting. It would be nice if the Biden administration could make more aggressive use of the power of its purse to really crack down on restrictive zoning and excessive permitting requirements. That would be another way to increase demand. That would help bring about, downward pressure on rental prices and home prices without continuing to ratcheting up the interest rate cost of credit. So it seems to me those are a couple of things that could be done to ease the pain. But we really need to, it's amazing to me that our fiscal authorities, our Washington political leadership are not focusing more, laser focused on increasing supply of affordable housing, and multifamily is absolutely the place to start. So I would be looking at all the ways I could to increase supply. But yeah, I mean, that's a problem with interest rate increases. They hit everybody, right? It's very hard to target and say, oh, your interest rates are going to go up and yours aren't. That just isn't the way it works. So supply, easing constraints on supply seems to me that would be the best strategy. And the administration's done a little bit of that, but not nearly as much as I think they could and should.
One of the unique things I would add, you touched on it, multifamily has Freddie Mac, Fannie Mae, and HUD as
Right,
lenders who continue to lend even in these market conditions.
right.
Most commercial real estate doesn't have that,
That's
right?
true.
You're sitting
Yeah.
in a hotel needing refinancing as an owner, or industrial or retail. There really is no lender of last resort. We have institutions here that are set up to provide affordable housing in the US and just housing supply.
Right,
That's sort of unique to multi, and it's one of the reasons that we're in it.
right,
That's one of the reasons it's been the safest asset class, and you can't understate the fact that you have access to credit at a price always.
right, right. Yep. So, no, I agree. And like I said, I think they lowered the caps for Fannie and Freddie doing business in multifamily. And I know there was some, I don't know where your group was in that, there was some industry pressure to do that, but it seems to me that, again, they should be using other tools, given the need to continue to fight inflation. They should be using other tools to make financing, targeted financing more available. And for heaven's sake, make it easier and less costly to build these, build multifamily structures to begin with.
Here's another thing you mentioned that I completely agree with. We're undersupplied in housing. That's
Yeah,
purchased housing as well as rental housing.
that's right.
And it was sort of created in the last Great Recession, that you were overseeing the FDIC and you saw it. It's never really been fixed. It was starting to get fixed, but it hasn't. And I can tell you what's happening now. There's very, very few homes or rental buildings being built. It
Yeah,
started in Q3, extended to Q4. It's going to be worse in Q1, Q2, because when you can't get financing, you can't start projects.
that's right.
And so that long term will cause a greater housing shortage,
Right.
and it'll create even more pressure the wrong way on inflation. You're gonna, that's your natural
Yeah, no, that's right.
rent
It's a
and
classic supply demand imbalance that's been driving it. And again, which in demand was really turbocharged with monetary policy. Well, if this group has any suggestions, I've mentioned a couple, but I think if there's more the GSEs could play. I think that's worth pursuing. Because it's just, homelessness, people, and it's not just the very poor. I mean, boy, middle class, even upper middle class are having a hard time finding a house or rental apartment they can afford. And, young people having to team up with 2 or 3 roommates because they can't. I mean, this is not, we're not serving younger generations in particular well, who are just entering the housing market. It really is. And I'm very concerned about it. So any, other suggestions you have now or later, I'd be open to hearing them.
yeah, I mean, one of the things Congress did do was, the qualified opportunity zone
Right.
legislation, which, it was passed in late 17. We're actually one of the larger managers of multifamily qualified opportunity zone investing in the country.
Mhm.
And they're talking about extending that law. They were. I don't know if they're going to do that or not. But the challenge with opportunity zone investing is you have to create a gain in order to get the tax.
Oh, right. Yeah.
Tax deduction, right? So what we need to do is layer actual equity investing into projects to make them viable.
Mm-hmm.
And that's harder to do, but that's what's necessary. So if I'm a qualified opportunity zone fund manager, I'm a fiduciary to my investors. I have to make a return. And if you're going to have us, build in areas that the rent doesn't support the price to build, you have to help in the equity structure.
Right.
Right. And
Yep.
and that's the part that is elusive right now.
The missing piece. Yeah. That's interesting.
Some cities are doing it,
Mhm.
but it's certainly not a state or national initiative, and
Right.
that needs to happen.
Okay. That's a helpful perspective. Thank you.
I'm going to move to Doug. You have a bunch of questions. I don't even know where to start, Doug. He has a question about regional bank construction loans. Do you think that those will be less likely to, is it going to be harder to get
Yeah.
a construction loan of any kind from a regional bank? I'll start there.
Yeah, well, I think any kind of lending that is viewed a little farther out there on the risk curve is going to be harder to do. The problem is that banks, also with interest rates, banks have a very safe place on the newly issued, government debt. They've got a pretty good place to park their money. And so to the extent they can still earn a decent return now on a treasury, putting their money there is their decision making is going to be skewed to those safe assets, especially with recession risk. And so, yeah, my guess is it is going to be get harder. And that's unfortunate, but this is the problem with regulation is highly pro-cyclical. Examiners start tightening up just at the time when the economy needs credit. And we tried to institute something called a counter-cyclical, regime, so that during good times, banks would build up greater capital levels so they could continue to freely lend in downturns. But in practice, that hasn't worked out. Banks really push back on having to build up capital buffers in good times. And again, that pressure to pay shareholders and generate big returns. So I don't know how well equipped they're going to be to continue to do any of the construction lending. Certainly is there's fairly significant capital charges against it, and so I can't say that I'm optimistic about that. But again, I think most regional banks are, if you're talking to a U.S. bank or a PNC or one of those, I mean, they're fine. Go. You don't need to take my word for it. Go look at their financials. But they were the ones. They can't, if it makes you feel better, this is why I'm really concerned about making sure we don't expose unnecessarily regional banks to unnecessary uninsured deposit runs, because they really were the backbone in the great financial crisis. They did keep lending when the very largest banks were pulling back. So I think if you have those relationships, you've got a good project, solid project, well-managed, experienced, talk to your bank. And I think regional banks and community banks are probably going to be, for the smaller ones, are going to be your better bet than the very largest institutions.
When I was hearing you just now, I was just thinking about how inverted the yield curve is when you're talking about banks have a really nice option of going into risk-free government debt at very high yields.
Yep.
Isn't it made worse by the fact that even the least risky debt is the 30-day government debt, right? Because you're not even taking duration risk. You have optionality because you can redirect it into another investment in 30 days. And that's also the highest returning.
Yeah,
right? So,
it absolutely is.
The Fed starting 4.5, if they tighten again, it's 4.75. You can get that type of return, but a 10-year note this morning is 3.44. It got as low as 3.35 this morning. I don't know what it is today because I'm on the webinar, but let's say it's 3.4. That's a massive.
That's a nice return. Okay. Yeah.
And so for people that don't think that a recession is likely, I mean, the bond market is telling you it's flashing red. It's not orange. That's the biggest diversion that we've seen. How long? 40 years?
Yeah. Well, no, 40 years. Yes. It may be historic now. I'm not sure. It was getting so deep before these bank failures, and then it actually started reversing a bit because people assumed that the Fed would hit pause on rate hikes. So it's lessened a bit, but it's still pretty steep. And I mean, I think I wrote a piece for the FT, when they started, it's about a year ago, I guess, when they started tightening. I said, sell assets. So they're focusing on short-term rates, and the way they raise short-term rates is they basically pay banks not to lend. This is a new thing, a tool they got after the great financial crisis. So they have, banks keep their excess money in reserves. And then there's also a reverse repo facility for large, like money market funds and large non-bank financial institutions. And the way the Fed increases rates is they increase the rate they pay on the reserve accounts or on the reverse repo. So that's a nice, you park your money at the Fed, that's a risk-free trade, and they're getting up 3.5% now, 4.5% now. That's a really nice trade to have. And they're basically paying you not to lend. I said, why don't you sell assets? This is going to cost you a ton of money. It's going to cost them a couple $100 billion a year to keep paying higher and higher rates to basically get these institutions not to provide credit. Sell assets instead, because that puts pressure on the long, right? On the long end, not the short end. But they've let their portfolio run off a bit, but the mortgage backs are really not running off at all because, nobody's refinancing anymore. So the duration is significantly extended. And so they still continue to be primarily focused on raising these short-term rates, which puts the extreme pressure on the yield curve. Which, yeah, and if you're the business of borrowing short and lending long, you don't want to be in that business right now. So yeah, you're going to keep everything short. Be safe. And unfortunately, the regulatory process, examiners may be, the pendulum always swings too far one way or the other, having a pro-cyclical response and further constraining credit by encouraging banks to play it safe given the likelihood of a recession.
How concerned are you? This is my question. I'll go back to live, but I have some. How concerned are you about the Fed balance sheet? Because you're touching on that now, and how the Fed is behaving. So, I believe in your tenure, that balance sheet got as big as 1 to 1.5 trillion.
Yeah, we thought that was big.
And I read this weekend that it's between 8 to 8.5 trillion at this point. Yeah. It's come down a little bit, maybe from 9. Yeah. But what concerns me is how much dislocation we've seen. Yeah. And we're still at 8 to 8.5.
Yeah. Yeah.
So where's this end? Where's it going?
Well, yeah. So a lot of it, they're kind of, instead of draining money out of the system, which you would do with asset sales, you're kind of just locking it up by paying banks not to lend. And I think I don't think it's, I'm very worried about it. I don't think it's a very good tool. I mean, the Fed the Fed can print as much money. So their, earnings have been significantly negative for a while now, but it doesn't matter because they can print money to cover their shortfall. I think where it does matter is how it interferes with monetary policy. So for instance, why haven't they sold securities? Well, they don't want to sell securities for the same reason SVB didn't. They didn't want to take market losses because they, especially on their MBS, they've got some huge market losses. But to the extent, when you have this, with all the massive buildup of your securities portfolio, when that starts interfering, your fear of taking losses starts interfering with your ability to effectively conduct monetary policy, then we've got a problem. So I think one of the big lessons of this, protracted area of easy money is quantitative easing is a really bad idea. Didn't trickle down to the real economy, made wealth inequality a lot worse. They've got this massive portfolio they can't run down effectively. They're stuck with it. They've got these huge, liabilities, hundreds of billions of dollars of interest payments now they need to make. And it's going to get worse because this JP Morgan Chase, they announced this new term loan facility where in response to the problems at Silicon Valley, actually Signature did not have this, the HTM problem was not an issue at Signature, but it certainly was at Silicon Valley. So they have this new lending facility where you can pledge your collateral at par and no discount, you can get a full loan for a year at par value. JP Morgan Chase had analysis of saying that facility could do up to $2 trillion of lending. Hopefully it will not do that much, but that's the capacity and impossibility that it could. So now you've got the Fed tightening credit on everybody else, but still pumping money into the banking system in a way that's just perverse. It's just perverse. You got to do what you got to do to keep the banks liquid, but it's just a symptom of too much money, too much cheap money, too long. And in our financial sector got too big because of it. And now we've got this huge system that needs to be propped up with monetary accommodation that's not being provided to the real economy, including probably the cost of your construction loans when you try to take one out.
Interesting enough, the spreads haven't really gone out. It's the risk-free rate. Right. So when you get 4.5 and the spread's 300, you're at 7.5 in a hurry. Right.
Yeah, that's right. That's exactly right.
Rate.
Yeah.
During the financial crisis that you were in the middle of overseeing, at least the reaction to, the spreads went out too.
They did. They blew out. Well, that may still happen.
You remember the joke from the GFC, what LIBOR was. LIBOR was the rate by which a bank wouldn't lend to another bank. Right? It was the published rate that no one would lend to each other. And that was totally true.
Yeah, no, it's
people
true.
Don't realize that now it's SOFR, but they don't realize that SOFR is not the Fed rate.
Yeah.
It's the interbank rate, and it acts like the Fed Doesn't.
Well, I mean, one of the reasons, I mean, SOFR, I mean, the Fed is SOFR now with its reverse repo facility. It's controlling that rate.
Now,
So that, yeah, so that may, but so maybe that'll contain the credit spreads, but it won't do anything with the bank's decision whether they're going to make the loan at all. And so, well, we'll see how it plays out.
we do have a question from Sal on the Credit Suisse collapse and deal with UBS over the weekend. I think we should probably make it in relation to how it might affect
Sure.
the US. And
Yeah.
at the end of the day, our clients are probably not.
Right.
They want to know how it affects them.
Yeah, yeah. I don't think it'll have, I mean, it's just, so I think it was handled pretty smoothly. There were some unusual features of it, but it's being handled smoothly. People are not worried about Credit Suisse failing anymore. So that's good for system stability. I think it's really separate from the issue we're seeing here with regional banks, the smaller banks, and uninsured deposit outflows. So I don't know how much it will help. But certainly, if it had been a disruptive failure, they hadn't been able to find a buyer, it would have been unsettling here. The Credit Suisse has been in trouble for some time. I think banks just on their own have limited their exposure to it. I think in the U.S., well, now that UBS is buying it and pretty much even protecting shareholders, there's not going to be any knock-on impact. So overall, I think it's good news for U.S. system stability. Again, it's not directly related to what we're seeing. It's a different problem we're seeing with the regional and smaller banks, but it's certainly welcome that's off everybody's worry list now.
So anonymous question about Tier 1 capital. Their understanding, and I believe this is correct, government securities get the least haircut for Tier 1 capital analysis. Is that right?
That's right.
And so isn't that part of the problem here? Interest rates were essentially 0 to 1.5 on 10-year yield, and you didn't take any Tier 1 capital risk hits from investing in them. So you were incenting banks to essentially make really risky trades, even though they were riskless from a credit standpoint. Really, it was high risk in terms of the level, the nominal interest rate. Yeah.
Well, no, that's right. And again, it's just fighting the last war and being focused on credit risk when really it's market risk and interest rate risk at this point. So yeah, I mean, the government gives very powerful incentives to banks to buy government debt. Their risk weighting is 0. Now you still have a leverage ratio that's an overarching capital requirement that applies on all of a bank's assets. And for years, the large bank lobbyists have been trying to get the leverage ratio weakened so that you would take all your treasury securities out of the leverage ratio denominator, which would have really given banks a powerful incentive to buy treasury debt, because then they could use 100% leverage. And that's, so that's a nice deal for them. So fortunately, we did not do that. That's what they did in Europe when you had all those banks loading up on sovereign debt. So the leverage ratio has mitigated those incentives a little bit, but they're still pretty powerful. And then the liquidity ratios to count treasury securities as high quality liquid assets. So the liquidity rules provide powerful incentives for banks to load up on treasury too. So yeah, that really needs to be a reassessment of the kinds of incentives, these favored asset classes that regulators create through their rules, and the kind of the herd mentality that forces banks into them because the incentives are just so powerful. We had it with mortgage-backed securities before. That we all obviously saw that didn't work out so well either, which also got a very low risk weighting.
We have a bunch of questions on the SVB board, and they want specifically to know about if you're a board member, what's your liability? Why weren't you asking the questions that Sheila was asking today? You're a board member. People seem frustrated. I'll just say that. Yeah. Well, I think that's right. The board bears responsibility too. I think first line is management. I mean, boards cannot run banks for them. And I don't know what kind of discussions, if the board was challenging them on this or just kind of going along with it. So they do bear responsibility. I still think, what your beginning question, management is primarily owns this, and boards, because I do several boards. I don't, they should be held account too. I don't suggest that, but I do know as a board member,
you have to rely to some extent on the information management's giving you. It's not, you can't run a bank for management. So I don't know what kind of, hopefully they at least saw this and were challenging management. And again, that doesn't excuse them, but I guess I find them less culpable than management in this case, or in any case. That management needs to run the bank.
Well, Sheila, I have a question that I'm going to have you ask yourself. I always end interviews this way. Is there anything that you wanted to cover that we didn't talk about? Is there any question that you feel wasn't covered that should be? We've really enjoyed having you, but I'm sure, or you could simply just tell people again how they can protect themselves.
Yeah, so no, this has been a great discussion. I learn from these kind of sessions too, because it helps, people in the industry and multifamily hear what's on your mind, what kind of challenges you're facing. And so I do think, until the government provides clarity on uninsured, whether uninsured is protected or not, and they haven't provided that clarity yet, I do think you need to protect yourself. But again, I think if you have a successful long-term relationship with one of the healthier regional banks, I think you're fine. There's plenty of market data, financial data. You can take a look yourself and look at, but my guess you'll see high levels of capital, good asset quality, not a lot of unmarked securities, and in a very, very large insured depositor base, which is stable. So, but do your homework. And if you're not sure, again, there are easy ways to get more than 250,000, even by keeping all your money at one bank. Have a conversation with bank management about that. Go to the FDIC's website and use the calculator to see the maximum amount you can get per bank. And then there are other tools. There are these deposit swap. Some banks participate in those. Different accounts may qualify, others may not. And then, of course, there's the ability to sweep. Some banks offer sweeps into money market funds. But if you're doing that, make sure they're short-term government money market funds. And good luck. Good luck. We'll get through this.
Thank you so much for your time. I really appreciate it. I thought the discussion was great. If you have questions, she's gonna get off right now, but we're gonna cover Origin's own take on what next steps are in this unfolding saga and what we're doing to mitigate risk along the way. Thank you so much,
Okay.
Sheila. I really appreciate the conversation.
Thank you. I enjoyed it too. Bye-bye now.
So I think we're gonna load up a slide right now. I'm gonna cover what I believe the potential on multifamily investing and the opportunities will be here. We touched on this a lot in the interview, and I actually really appreciated her insightfulness on our industry. So first and foremost, we'll see across the industry, you're gonna see less lending in multifamily, but more broadly in the economy. That means home loans, car loans, credit card loans. Banks are going to be less apt to extend credit because they're worried about their own balance sheets in the short term. And to her point, she made a very good point. They have a alternative. The Federal Reserve is paying them a really high return to give them the money, right? And so they have a very good alternative to lending. So that's going to, the good news is that's deflationary. So you're going to see, the banks will start doing the Fed's work for them. Maybe the Fed doesn't need to raise the risk-free rate so much more because banks are going to start pulling money out of the economy themselves. And multifamily is related somewhat because we have, as I said before, Freddie Mac, HUD, Fannie Mae, other lenders who can step in and do step in and continue to lend. But the net is lending will be less available for development, for refi. What does that mean? Probably asset valuations will go down, number one. So if you ask me where I think commercial real estate asset valuations are going, I think they're probably going lower. How much lower to be determined on candidly how much the credit pulls back from commercial real estate. What does that mean? Enormous opportunities, actually, for us, for Origin, for you as an investor in Origin's funds. We've never performed as well as we did in 2009, 10, 11, 12. These were the fully distressed years in the economy. That's where we actually perform best because we're so good. Restructurings, foreclosures, short sales, bankruptcies, gap capital, which is, exists now. So, the first step, if it gets dislocated, that's my opinion, and there will be dislocation. The first step will be recapitalizations. People need new equity to come in as they refi and they can't get enough to take out the last loan. That's the type of capital in the deals we're seeing now. I'm not seeing distress yet. If recapitalizations don't produce enough liquidity for owners, then they start to lose assets to their senior lender. At that point, you have distressed opportunities to buy either loans or foreclosed assets. To be clear, we're not seeing that yet. Although, in my opinion, we will see it by the end of this year. And the question in my mind is it going to be one-off, a few here and there, or is it going to be much more systemic? I'm not sure of that, but I do know that I'm really excited about Origin's opportunity to take advantage of the recapitalization market, which already is happening. We're getting anywhere from 14, 15% on protected capital now, preferred equity investments at very stringent underwriting. We like those opportunities. The next step would be investing, which we're very experienced at doing. Don't know if that'll happen. And of course, what I'm really excited about is when we were talking about supply earlier, we're undersupplied in multifamily. The long-term fundamentals are really strong. And so this dislocation is an opportunity. If we were talking about an asset class that I don't believe in the long-term demand, just to single one out, office, I don't believe in the long-term demand in office. I couldn't tell you that it's an opportunity because I don't know what the demand is over time. I know that we have a housing need that's not being met, and it's getting worse every quarter because there's less and less new development happening. So that is what I think the next 6 to 12 months look like. And obviously, the longer the banking dislocation happens, the more the effect will be on lending and the reverberations across the economy. The last thing to think about, if you're paying attention to what's going on, it's also potentially an effect on your own demand. And people underestimate that. So if you are more nervous so that you are not going out, making a purchase, a capital purchase, a vacation, any consumption item, that consumer confidence element our economy, because most of our economy is a consumption-based economy. So the longer this stays in the headlines, the longer people fixate, the more the effect will be on our own behaviors, which then produce lack of demand. And the inverted yield curve isn't lost on anyone at Origin. It's way too wide of an inversion to ignore, and it's incredibly predictive of recessions. And so at this point, if you're not aware of how inverted the yield curve is and how predictive it is as a measure, you really should do research on it and think about what the potential risk could be. With that, I'm going to hand it to Marc. Marc, I know you wrote an article on our own risk management in relation to deposits and cash management. And you can also give an update on what we did last week to kind of finish that process.
Yeah, thank you, Dave. So Sheila talked about it in pretty good detail of all the different tactics that you can employ to create additional insurance and risk management on any deposits you have with whoever your banking relationships with. We've done the majority of our banking with Wintrust, which is a local Chicago-based regional bank. And so when this news broke, we immediately started to take a deeper dive into Wintrust, the financial health of Wintrust. And what we learned was the bank has, fairly healthy liquidity metrics and hasn't taken the similar risks or mismanaged this risk management in such a significant way like SBV did. Nonetheless, banks like a Wintrust could be subject to significant outflows of deposits, and that's a risk. So we immediately, when the SBV news broke, took action to move 77% of our cash, your cash that sits in our various funds, into short-term U.S. Treasury bills. The key there being short-term is, as Sheila advised, the remaining cash, the other 23%, is cash that we need to keep on hand as we're deploying that on a daily and weekly basis into our portfolio investment activities. But then we took some additional steps. We're setting up a system whereby we mentioned in the article 100 million of deposits. That's now up to 125 million of deposits at Wintrust will be protected by FDIC insurance, and that's through a number of different programs, one being IntraFi, which I think Sheila mentioned. That's essentially something you can do. It's the quick way of, instead of you going to 5 or 7 different banks to move your money around, to have it in an individually protected FDIC accounts. Your bank that you have a relationship with, if they're a member in the IntraFi system, will disperse that through a number of different banks, and you're getting the same level of protection. And so that's something that we're putting in place. So essentially, we will have all of our cash fully FDIC insured and protected, and at no risk to investors. The other thing that we did in stark contrast to SBV's management is, and Sheila talked about this a lot, they were incentivized to invest in treasuries because of the regulations and the various ratios that the regulators are focused on. But they didn't put any hedging strategies into place, and that was a major downside risk for them that came home to roost last week. And so one of the things that we noticed in early 2022 was that it should be no surprise that the Fed will likely raise interest rates, and it became more clear that they were going to take a very aggressive track on raising interest rates to fight historically high inflation. And so we started to take action there in terms of immediately hedging our long-term interest rate risk. And today we've generated about 43 million in gains that we can use to offset higher interest rate risk. That's a key part of our strategy. It was never intended to say, let's take advantage of potential movement in interest rates. It was, we don't know where this will end up. It's impossible to predict where interest rates will go, even in the future. There's a lot of discussion, and Sheila touched on it, what the Fed may do this week. But we don't know long-term, and we're long-term investors. And so to do nothing was a strategy that we could not live with. And we instituted this hedging strategy, which is, as far as today goes, has paid off significantly, and we believe a key part of our risk management strategy. Sheila talked about, regional bank health, and most of our construction lending is with regional banks. We do have some larger banking relationships, but over the last 6 to 9 months, those larger banks have not been as active in providing construction loans in multifamily space, and the regional banks have been very active in filling the need for additional housing in the U.S. So the majority of our banking is with regional banks that, when all the news broke on SVB and Signature Bank, were certainly raised concern, and we immediately started to do a full analysis on their liquidity, their capital ratios, and then specifically looking at the things that got SVB in trouble. How much of their assets are tied up in long-term bond holdings. And the good news is that pretty much throughout our lending relationships, there aren't significant risks. There's a couple banks that we flagged for further analysis, and we're going through that now. But none have made the same mistakes that SVB and Signature made. They're not heavily in crypto. They're not more diversified than SVP, where majority of its deposit relationships were in the tech startup sector. And although our banking relationships do a lot of real estate lending, they haven't done a lot of office from what we've been able to determine, which is another risk factor that we've identified. We go into this in greater detail in the article we wrote with specific analysis behind it, and we'll continue to watch those relationships because if you go back 30, 60 days, SVB's ratios, the ratios that are most commonly looked at to determine a bank's health, were fairly healthy, right? And so we're looking at those, but also are lifting the hood up and digging in a little deeper into things like, okay, how much investing have they done in long-term bonds? How much unrealized losses that they're not required to report or account for on their balance sheet that we should be worried about. And the good news is there isn't a significant concern there, but something that we will keep a close eye on. With that, I think, Dave, we're ready to answer any more additional questions.
Thanks, Mark. Richard had a question that I'll answer. It's a great question. I mentioned that I think there's going to be really interesting recapitalization or distressed investing opportunities. Of note, we haven't really covered this on this webinar. Origin hasn't purchased a stabilized cash flowing building in over 3 years. To give you an idea, we've been managing risk for an awful long time, and we believe that assets have been overvalued for an awful long time. And so we've been kind of getting ready for this, and our existing funds are very insulated and protected from this. Now, in terms of new opportunities, they will exist in 2 places. One is the Income Plus Fund. The Income Plus Fund can buy stabilized built buildings. It can buy, we have lots of flexibility of how to invest into that fund. And the Income Plus Fund takes advantage of all of the competitive advantages that Origin has, whether it's in credit, through investing in preferred equity. That's 60% of the fund right now. Again, we wanted to be very defensive for the last 3 years. So that fund is structured that way. But if asset valuations start to change, that fund can also change its investment thesis. And we can start moving more towards common equity positions that we believe in good markets and high demand sector like multifamily will do very well over time. Remember, that fund is a long dated fund. It wants to be tax efficient. You want to own that fund for long periods of time. Right now, it's very defensively positioned. It could be in a year or two, it's less defensively positioned because we want to have more upside because valuations were much lower getting in. The other place that you're going to have an opportunity is our second multifamily credit fund. I believe we're going to call it the Income Credit Fund. It's also going to be open-ended, long-dated, meaning you want to stay in it for long periods of time. The yields are really high right now. You can get, well north of a 10% unlevered yield on the types of bonds that we think are very, very safe. The other thing that the Income Credit Fund will be able to do is buy distressed notes. And so if there's a vibrant distressed note environment, which Origin is very experienced in, it was really the first 3 or 4 years of our existence, it's all we did. They will go into income credit. And so, it's difficult to know what types of returns that fund can get, but certainly they're quite high right now. And that fund will be launched in April of this year. So no assets in the fund to start, and we'll be raising capital to take advantage of what we think is a really interesting time in multifamily credit and potentially multifamily distressed credit. So thank you, Richard, for that question. Another question, maybe Mark, that you can answer, because I know you were square in the middle of these valuations. And I did this webinar, and I can't remember if I did it with you or another Origin team member, but the Growth Fund 4 projections on the last webinar were brought down to 11 to 14%. By the way, that's a net return. Prior, they were 12 to 15, so we lowered them slightly. Can you talk a little bit about how we got there, why we lowered them, And then the question specifically, this is anonymous, was that webinar was before the SVB banking collapse. Would you expect to further revise down those projections now? You can handle that. Thanks.
Yeah, certainly. It's a great question. So we revised those projections down to take into account of what we're seeing in the market. So we're constantly reevaluating, updating our cash flow forecast, which are the basis for evaluations on every fund asset, not just Growth Fund 4, but we're starting to see cap rates expand out to where they were, 6-9 months ago. We're also factoring in somewhat slower growth projections than where we were about a year ago, though we've been projecting that there would be a significant slowdown and even declines in rent in 2023 for quite some time. So there wasn't a significant movement there, but those are both contributing factors to why we brought in those valuations. But when we do this too, we're trying to not only just react to what's happening in the market, but and it's, we don't have a crystal ball, but we're looking out to say, okay, what's next, and building in some additional cushion. And so if lending does become significantly tighter in the near term, and spreads blow out, so forth, any debt that we're trying to source for any deal, which majority of deals in Growth Fund 4, the debt has already been sourced. There are a couple that we would continue to finalize that could have an impact on, obviously, on the cash flow of those deals. For the most part, that risk has already been mitigated by, we've already originated loans. But in the long run, as Dave noted, this could have a positive impact on rent growth, as it would limit supply. And so we'll continue to monitor it, but the one thing we try to take into account is a level of some conservatism and a level of cushion, so that right today, I don't believe the SVB signature, collapses are going to have a major impact on that underwriting, but we'll continue to monitor.
Thanks, Mark. I'm going to take one more question, and then we're gonna end this. We're a little bit over, but I think it was a great webinar. It was great to have Sheila join. Terrence, you asked a question at 9:30 when Sheila was still here. I wanted to cover it myself, so I left it. But thanks so much for your question. The question is, how will this affect multifamily construction debt, permanent debt, equity flows, asset values, cap rates, land values, and construction costs? That's a Terrence. But I'm going to do it in 1 minute. Construction debt, I already mentioned, it's going to be more difficult to get. And we've covered that at length. Permanent debt, because multifamily has lenders like Freddie Mac, HUD, et cetera, and the risk-free rate is much lower than it was pre-SVB, right? So you were talking about a 2-year note yield that was above 5, now it's below 4. And that's a massive move. A 10-year note that was well above 4, and now it's 3.4 as of this morning. So permanent debt is a little bit harder to know how much you'll get, or even the rate, because even if spreads go out, the risk-free rate's lower. So that's TBD. Equity flows, I think equity flows are going to be somewhat lower in the beginning because there needs to be price discovery. So it's not, equity flows don't mean flows into funds. I think that Origin is going to raise a tremendous amount of capital into our funds, but that doesn't mean that I'll invest it, because I want to see price discovery. I want to see follow through. I want to see interesting opportunities emerge first. So that's my opinion. I think the equity's there. I just don't know if it's ready to actually flow into assets. Asset values, I was very clear about that. I think real estate values are more likely to decline than go up based on what's happening now. It's unclear to me how much. So does that mean 5%, 7%? I'm not sure of that, but I do think it's more likely they go down. That, which was cap rates, I think that asset values will decline because cap rates are going up. People need to offer a cap rate that's commensurate with the risk-free rate being 4.5, right? And so, like, at a certain point, if you give 4.5 on cash that's government guaranteed, Why do you want to go into a 4.5 cap rate? The answer is you'd have to believe in enormous growth, right? Of that cap rate. And then I believe, hold on, someone's asking questions, so my whole question thing slid down. What was the last part of the question, Mark? Construction costs.
Construction
Land
costs.
values.
Yeah.
So land values, we're already seeing land values are coming down. They have to, relative to what's happening, but they haven't come down a lot. And so, in our funds, we bought our land really well. We still believe our land is below where stuff is transacting, but candidly, not much is transacting. And then the last question was construction costs. That's probably the good news in all of this. Construction costs will come down. In fact, it's already coming down, but not quite as much as we would expect. I would say in Q3, Q4, it stopped going up. In Q1, it's actually started down. It's more like, 2%, 4%, 5%. And it's also regional. So, it's coming down in Florida, but it's not necessarily coming down in the West. And I think that my opinion is it will continue to come down because there's just so few new construction projects starting. And eventually that trickles in. You have to remember a lot of the projects that were started in 21, 22, or even 20, they're still happening, right? They're still building. And so the subs are still busy. The GCs are still busy, but that can only last so long. And they're going to start to realize that, there is no next deal. And that's when I believe you're going to see the construction costs come down. All right, Mark, thank you so much. I thought you covered that very well, but moreover, thank you for your risk management all of last week, both with the analysis and more importantly, the execution.
Yeah, no, thank you, Dave. I thought it was an excellent conversation with Sheila today. Very interesting.
And thanks everyone for your
Thanks for
time. We will share the recording. We'll also share the slides. And if you have questions that weren't answered, you can always email me at david@origininvestments.com. And Mark, are you Mark or M. Turner?
I'm M. Turner. M as in mom, Turner at origininvestments.com.
Yeah, you don't usually give your email, but I just threw you under the bus. Sorry.
Yeah, no, please. Happy to answer any questions.
Remember that. All questions go to M. Turner. All right, have a great day, everyone. Bye-bye.
Thank you.